It wasn't a sudden error in policy. It wasn't a miscalculation by a few incompetent officials. It wasn't even a reaction to a singular crisis like a war or a plague. It was the final desperate mechanism of a system that has run out of road. The data is public. The balance sheets are visible. The pattern is unmistakable. When a dominant power accumulates more obligations than its economy can support, when the cost of maintaining global order exceeds the revenue from taxation, when the interest on the debt begins to consume the treasury, the authorities always choose the same path. They do not cut spending. They do not default honestly. They do not tell the public that the standard of living must fall. Instead, they change the measuring stick. They dilute the currency. They manipulate the ledger to keep the game going for one more round. The arithmetic is merciless. History shows us that this decision is not a matter of ideology. It is a matter of incentives. Under the constraints of a sovereign debt trap, the rational move for any ruler is to sacrifice the value of the currency to preserve the structure of the state. We are witnessing a historical recurrence that has destroyed the greatest powers in human history. The central banks have begun to operate with negative equity. They have stopped remitting profits to their treasuries. They are buying assets that no private investor would touch. Current prices. They are quietly preparing for a shift that they cannot announce without triggering a panic. To understand where we are going, we must look at where we have been. The roadmap is etched in the ruins of Rome, in the bankrupt courts of imperial Spain, and in the wheelbarrows of paper money in Weimar Germany. This isn't about politics. It is about the life cycle of empires and the inevitable mathematics of debasement. The timeline is compressing. The signals are flashing red, and the precedent is terrifying. 3 specific historical cases prove this pattern beyond a shadow of a doubt. Let's begin case study 1, the Roman Empire, specifically the period stretching from the reign of Nero to the crisis of the 3rd century. This is the archetype of all monetary collapses. The Roman state at its height was a machine built on conquest and plunder. But as the borders stabilized, the influx of new wealth slowed, while the costs of the military and the bureaucracy continued to rise. State faced a simple accounting problem. It promised more silver to its legions and its citizens than it could mine from the earth, ground or extract from the provinces. The turning point can be anchored to the year 64 A.D. Emperor Nero, facing the immense costs of rebuilding Rome after the Great Fire, made a decision that would doom the empire. Centuries later, he did not raise taxes, which would have been politically dangerous. He did not cut the military budget, which would have been suicidal. Instead, he ordered the mint to reduce the silver purity of the denarius from 100% to roughly 90%. He also slightly reduced the weight of the coin. It seemed like a brilliant solution. The state could mint more coins with the same amount of silver. The soldiers were paid, the workers were paid, the economy appeared to hum along, but the incentive structure had been altered. Once the taboo against debasement was broken, every subsequent emperor used the same trick to solve their own short-term fiscal crises. By the time of Septimius Severus in the late 2nd century, the silver content had dropped to roughly 50%. Severus famously told his sons, "Be harmonious, enrich the soldiers, and scorn all other men." The payoff was immediate loyalty from the army. The risk was the destruction of the civilian economy. By the mid-3rd century, the currency had collapsed completely. The Antoninianus, a coin introduced to replace the denarius, became a copper coin washed in a thin layer of silver that would rub off after a few transactions. This was not a secret. The incentive for the state was to push the face value of the coin far above its intrinsic metal value. The incentive for the public was to hoard the old good money and spend the new bad money as fast as possible. This is the mechanism of Gresham's law in action. The social consequences were devastating. Prices did not just rise. They exploded. The state, realizing its own coins were worthless, refused to accept them for tax payments, demanding payment in goods, grain, leather, and uniforms. Think about what that means. The government that issued the currency would not accept it back. The middle class was wiped out. Soldiers, seeing their pay evaporate, turned to banditry, or installed new emperors who promised higher wages, leading to a cycle of civil war. We have a window into the life of the average citizen through the Edict on Maximum Prices issued by Emperor Diocletian in 301 AD. In a desperate attempt to stop the inflation, his predecessors had created Diocletian, set price ceilings on over 1,000 goods and services punishable by death. We know from the records that a stonemason would have to work for weeks just to afford a measure of wheat that once cost a few days' labor. The market's emptied merchants refused to sell at the mandated prices. The complex trade networks that fed the cities disintegrated. The Roman economy decomplexified. People fled the cities to work as serfs on large estates, just to survive, laying the groundwork for the feudal system. The empire didn't just fall, it dissolved, because the medium of exchange could no longer store value or facilitate trust. Just like Rome, the Spanish Empire in the 16th and 17th centuries found itself drowning in obligations it could not meet despite possessing the greatest source of wealth in the world. Case Study 2, the Spanish Empire. This example is crucial because it shows that even a nation with a monopoly on the world's money supply is not immune to the laws of arithmetic. Following the discovery of the Americas, Spain controlled the vast silver mines of Potosi and the gold of the Aztecs and Incas. Ships laden with treasure docked regularly in Seville. By all logic, Spain should have been the wealthiest nation on earth forever. But the Spanish crown, particularly under Philip II, who reigned from 1556 to 1598, was engaged in constant multi-front wars. The cost of maintaining the armada fighting in the Netherlands and defending Catholicism across Europe was astronomical. The influx of silver did not make Spain rich. It made the Spanish government reckless. They spent the money before it even arrived, borrowing heavily from Genoese and German bankers against future treasure fleets. When the costs outpaced the silver shipments, the crown resorted to the same mechanism as Rome: debasement. But they added a modern twist: sovereign default. Philip II defaulted on the state's debt 4 times in 1557, 1575, 1596, and later monarchs followed suit. But the most insidious tool was the manipulation of the domestic currency, the vellone. The vellone was originally a mixture of silver and copper. As the fiscal noose tightened, the crown began to mint vellone, purely out of copper. In 1599, the new king, Philip III, authorized the minting of pure copper coins with a face value far exceeding their metal content. The treasury bought copper cheap, minted it into high-denomination coins, and used the difference to pay its bills. It was a direct wealth transfer from the poor, who used copper coins for daily life, to the state. The inflation that followed is known by historians as the Price Revolution. But for the people living through it, it was a slow suffocation. A shoemaker in Castile in the early 1600s saw the price of leather double, then triple, while his customers could no longer afford shoes. The Spanish manufacturing sector was destroyed because Spanish goods became too expensive to export. It became cheaper to buy goods from England or France than to make them in Spain. The gold and silver flowed right through Spain and into the hands of its enemies, leaving the domestic population with worthless copper. Tokens: the psychological toll was heavy. Contemporary accounts describe a sense of bewilderment. The country was awash in money, yet everyone was becoming poorer. The incentive to work and produce vanished. The rational move was to seek a government post or a title of nobility, anything that provided a fixed income or tax exemption. This productive middle class hollowed out, the countryside depopulated. By the mid-17th century, the Spanish Empire was a hollow shell, politically dominant on the map, but economically rotten at the core. The crown had chosen to save the state's geopolitical ambitions by consuming the economic future of its people. Just like Spain, the Weimar Republic proves that when the debt is unpayable, the printing press becomes the only remaining policy tool. Case Study 3, Weimar Germany, 1914 to 1923. This is the most terrifying example because it happened in a modern, industrialized, highly educated society. It destroys the myth that it can't happen here The seeds were sown during World War I. Germany financed the war entirely through borrowing, expecting to pay the debt with reparations from the defeated Allies. When they lost, they were left with a shattered economy and a massive reparations bill imposed by the Treaty of Versailles. The London Ultimatum of 1921 demanded payments in gold or foreign currency, which Germany did not have. The government faced a choice. They could impose crushing austerity and taxes, which would likely lead to a communist revolution or a right-wing coup, or they could print paper marks to buy foreign currency and pay the workers in the Ruhr Valley who were on strike against French occupation. The president of the Reichsbank, Rudolf Havenstein, was not a fool. He was a technocrat who believed that the primary duty of the central bank was to provide liquidity to the state and the economy. He believed that the rise in prices was caused by a shortage of money, so he printed more to keep up. The mechanism was simple. The government issued bonds. The Reichsbank bought them with freshly printed marks. The commercial banks were allowed to discount bills without limit. The money supply exploded. In the early stages, the inflation felt like a boom. Exports were cheap, unemployment was virtually zero. Foreigners flocked to Berlin to buy real estate and goods for pennies on the dollar. But by 1922, the velocity of money took over. The public realized the mark was doomed. The incentive was to get rid of cash the moment you received it. By 1923, the situation descended into madness. We have accounts of workers' wives waiting at the factory gates. As soon as their husbands were paid, they would take the bundles of cash and run to the nearest shop. If they waited an hour, the price of bread might double. A single egg cost millions of marks. There is a famous anecdote of a man who brought a wheelbarrow full of money to a bakery to buy a loaf of bread. He left the wheelbarrow outside. For a moment, when he came back, the money was dumped on the ground, and the wheelbarrow was stolen. The wheelbarrow had real utility. The money did not. The middle class, the pensioners, the bondholders, the savers were liquidated. A lifetime of savings could not buy a cup of coffee, but those who had borrowed heavily to buy hard assets became incredibly rich. Industrialists like Hugo Stinnes borrowed marks to buy mines, factories, and forests, then paid back the loans with worthless paper. The wealth of the nation was not destroyed, it was transferred. It was transferred from the prudent to the reckless, and from the savers to the debtors. The social contract was shredded. The psychological trauma of the hyperinflation delegitimized the democratic government and paved the way for radicalism. The people wanted order, they wanted stability, and they were willing to accept anything, even a dictator, to get it. Just like Weimar Germany, the modern financial system is showing the exact same symptoms of a debt cycle entering its terminal phase. The pattern repeats in 7 distinct stages: stage 1, sound money and expansion. The nation has a currency backed by hard assets, or a strong production-based government spending is restrained. Debt is low. The economy grows on real productivity and trade. Stage 2, overextension. The nation becomes a major power. It takes on global responsibilities. It builds a large military. It creates expensive social programs. The political pressure to spend increases, but the politicians are unwilling to raise taxes to pay for it. Stage 3, the fiscal gap. The state begins to run chronic deficits. It borrows the difference. At first, this is seen as manageable. Bonds are considered risk-free assets. The banking system begins to treat government debt as the foundation of all liquidity. Stage 4, the monetary shortcut. The debt burden becomes so large that the interest payments threaten to overwhelm the budget. The central bank intervenes. It begins to buy government debt, artificially suppressing interest rates. This is the point of no return. The central bank is no longer independent. It is a tool of the Treasury. Stage 5, debasement and inflation. The increased money supply starts to chase a finite amount of goods and services. Prices rise. The authorities blame supply chains, greedy corporations, or foreign wars. They insist the inflation is transitory, but the purchasing power of the currency is permanently impaired. Stage 6, financial repression. The government realizes it cannot stop the inflation without crashing the economy, so it tries to control it. It implements capital controls. It forces pension funds and banks to hold government debt. It may cap prices or rents. It demonizes those who try to exit the system into gold or foreign assets. Stage 7. The reset. The currency is no longer functional. The system collapses or is reset by decree. A new currency is issued, often pegged to a hard asset or a foreign reserve currency, but usually at a conversion rate that wipes out the savings of the previous era. Here's the key. We are currently transitioning from Stage 5 to Stage 6. Just like in the Roman, Spanish, and Weimar examples, the data today suggests we are past the point of a painless solution. Let's map these stages to the current reality. Most observers agree that the debt-to-GDP ratios in the developed world have reached levels that are historically unpayable in real terms. The United States, the issuer of the global reserve currency, has a debt load that is compounding faster than the economy is growing. The central banks have already executed Stage 4. Since 2008 and accelerating in 2020, they have purchased trillions of dollars of government debt. They have suppressed interest rates to levels that do not reflect the real risk of inflation. Now look at the unprecedented actions that triggered this analysis. Central banks around the world, particularly in the East and the global South, are buying gold at the fastest pace in over 50 years. Why? Because they know the debt issued by the major powers is losing its value. They are hedging against the devaluation of the fiat standard. Simultaneously, Western central banks are operating with technical insolvency. The Federal Reserve and others are carrying massive unrealized losses on the bonds they bought during the low-rate era. They were private banks, they would be bankrupt. But because they write the rules, they can create a deferred asset on their balance sheet. This is an accounting trick. It is the modern equivalent of mixing copper into the silver coin. It allows them to operate. Despite being underwater, the incentive is clear. They cannot raise interest rates high enough to kill inflation completely, because doing so would bankrupt the government. The interest expense on the sovereign debt would consume 50, 60, or 80% of tax revenue. That is a mathematical impossibility. So the rational move, the only move left, is financial repression. This means keeping interest rates below the rate of inflation for a decade or more. This slowly transfers wealth from savers, who lose purchasing power, to the government, which sees the real value of its debt melt away. There is a counter-argument. Some economists argue that modern economies are different. They say that because we borrow in our own currency, we can never default. They argue that technology and productivity growth will be deflationary enough to offset the money printing. They point to Japan, which has sustained high debt for decades without hyperinflation. But this argument ignores the scale of the current problem. Japan had a massive savings surplus and a trade surplus. The Western world has a savings deficit and a trade deficit. Furthermore, relying on productivity to solve a monetary problem is a gamble. If productivity does not jump immediately, the currency takes the hit, and history shows that when push comes to shove, the political pain of austerity is always rejected in favor of the hidden tax of inflation. The arithmetic of the interest payments does not care about modern monetary theories. If the bill is due and the tax revenue isn't there, the money is printed. We are looking at three potential endgames. The first is controlled decline. This is the path of financial repression. The authorities manage to keep the system holding together, but the standard of living slowly erodes. Real wages stagnate. The price of housing, food, and energy climbs steadily out of reach. The middle class becomes a renter class. This is the boiling frog scenario. It mirrors the slow decay of the Spanish Empire. The second is chaotic collapse. This occurs if the bond market revolts. If investors refuse to buy the government debt at the offered rates, yields spike uncontrollably. The central bank is forced to print everything to buy the bonds, triggering a hyperinflationary spiral like Weimar or Venezuela. The currency fails completely, leading to social unrest and a breakdown of supply chains. The third is reset and restructure. This is the Bretton Woods scenario. The major powers gather and agree to devalue their currencies simultaneously against a neutral reserve asset, perhaps gold, or a new digital basket debt is written down or converted. The system is rebooted. This happened in the 1930s when Roosevelt revalued gold, and in 1944, and in 1971. The only variable is timing and pain. A pattern is set, the incentives are aligned, the history is clear. You cannot print your way to prosperity. You can only print your way to a default by another name. This channel is dedicated to tracking these shifts as they happen. We do not offer financial advice. We offer perspective. The best preparation is education. Understand the difference between currency and money. Understand the difference between an asset that has a counterparty and one that does not. Watch the data, not the speeches. Subscribe to stay ahead of the narrative.